Okay, so here we are at step 1, and we're journalizing the beginning entries for a company. Each entry is entered into a journal. There's a debit and a credit, obviously. So the first entry I'm looking at is where Peyton Smith has invested $5,000 into her company. Now, there's a $5,000 debit and a $5,000 credit. The next one is that she has paid rent expense. So the rent expense gets debited and the cash gets credited. We're taking cash and paying for it, and we're creating a debit or an expense account. She has decided that she needs insurance, and she's paying for a full year. Okay, so she's paying cash of $2,700 and creating an asset account. You notice it doesn't say insurance expense. It says a prepaid insurance of $2,700. Now each month they're going to take so much out of this account and apply it to the income or to the expense account. She actually did some work and received $1,000 in cash, but that $1,000, oh, wait a minute, let me rephrase that. She did some work and received $1,000 in cash, but the work was on an accounts receivable, which again is another asset, which means the person who she did the work for charged it. So she's now receiving cash, and she's crediting the accounts receivable account to decrease that amount owed. This one, it says, see, you've got cash, she's receiving cash, but it's a prepaid cash, or a prepaid revenue. Somebody has said, I want you to do this work for me, but work hasn't been accomplished yet. So this becomes an unearned revenue at this point. She's got the cash, she's been paid for it, but she hasn't done the work. So that's just it almost sits out there like a liability, because if she never does the work, she's got to repay that money. Here's an accounts payable. It looks like she charged something, and she's now paying for it, so she's crediting cash, which detracts from the cash, and adding it to accounts payable. We've got a miscellaneous expense that she's paid. Again, comes right out of cash, goes into the expense account. Bought some office equipment. Can't have an office without some equipment, so that was $7,500. Again, that's an asset account, right? And instead of paying cash, it went into accounts payable. Paid for some advertising, straight up. Advertising expense, evidently, is just for the month, and credited cash. Received $1,000 here. Somebody paid her. She did some work. Here you've got equipment rent expense. Actually paid for some equipment that she's renting. Credit to cash. See how you're journalizing these as you go through? Paid the wages. That adds into the wage expense and takes away from the cash. As you come down, here's another group. This one, she received cash for doing some work. She bought some supplies and added that to the asset accounts. Again, accounts payable because it's been bought on credit. Music expense, bought some music. Evidently the business involves music, and pay cash for it. Here's an advertising expense of $800, cash again. Oh, here's one that's split. This one is telling me, as you look at this, she received $750 worth of cash. The rest of it was put on account. Somebody charged her the account, and she delivered $2,500 worth of services. So this is a fees earned. Had to pay that light bill. Again, you've got the expense and the cash. Wages again, cash. You can see how we're just going down and writing out what the expense was for. You have miscellaneous again and cash. Here again, somebody paid $500, put the other $1,000 on account, and will probably pay for it next month, and this goes into revenues. Received cash. She's having a good month and received a fee for it. You've got another music expense where they paid for it with cash. And finally, at the end of the month, she said, oh, golly gee, I'm tired. I'm going to draw some money out and I'm going to go relax. That is the journal entries for the month. So the next thing we're going to look at is going to be how to put this in the general ledger. So thanks for listening. I'll see you in the next one, okay?